want to talk about is the activity that we saw on Friday morning when we had a weaker than expected jobs report. Only 175,000, expected 240,000. Unemployment rate went up just a tick.
Yes, it did. Yeah, went from 3.8% to 3.9%. Still a very good number. And actually, that 175,000, it was below expectations. And I think this was one of the first times in a long time that Wall Street's expectations were missed to the downside. What we've seen over the last year, the average pace of job creation has been 240,000 per month. And so a lot of people were expecting that higher number, and instead it comes in at 175, and the markets seem to really like that. Not only because it probably shows that the labor market has gone from great to good, but the wage growth has actually really moderated. The wages, I think, increased only about 0.2% month on month. Year on year was 3.9%. Seems pretty consistent with a low inflation environment going forward.
So you talked about a lot of stuff there. So let's break that apart. The average hourly earnings only up 7 cents. That's the 2/10 that you were talking about. And the average hourly work week went down a tick as well. So that was a bit of a surprise. But as you pointed out, the bond markets reacted to that because it really pushed the odds up of a rate cut later in the year from around 50% to 70%, according to CME. In September. So when the interest rates went down, some of the risk assets began to rally.
That's correct. Yeah. And now we're back in this really dance where if interest rates go down, that tends to be good for especially growth stocks, it seems like. Sometimes, stocks in the bond market, they can go their own way, but they've been really tightly tethered together. And a lot of it is just because the common driver of the Federal Reserve. Right. What are they going to do? When are they going to do it?
In a weird way, bad news is good news because we want wages to go up, but it did moderate inflation just a bit because of that. When we see Treasury yields go down, when yields go down, prices go back up. So the Fed is front and center again, probably talking about a rate cut later in the year. But we also saw some economic news and we saw some earnings news as well. We saw Apple. Their sales were not where they wanted to be, but their earnings was okay.
That's right. And I think that's where really the low expectations came in because really over the last month or so, it seems like a lot of people have thought, Apple, are they really in this artificial intelligence game or not? There have been reports about how maybe they are going to be teaming up with Google or Microsoft for the AI capabilities. And so when the earnings came out, there were those low expectations. We know that they've had challenges in China. The iPhone sales there were down. I think it was about 8 to 9% year on year because the government over there has told government employees not to use their iPhones, much prefer to use the Huawei devices or Chinese devices instead.
So, and Huawei is their provider over there versus Apple. Correct?
Exactly. Yep. And so that was a lot of people expecting that you were going to see this decline in revenues, but their earnings were better than I think people feared. And those buybacks, $110 billion.
So let's explain that, Professor. Of course, when a company buys their shares back, what happens?
Sure. Well, they go out into the market and they basically say, hey, we have, in Apple's case here, $110 billion that over the course of the next quarter, that they're going to use that to buy back their shares in the market. And effectively, if you hold on to your shares, you are owning a slightly bigger slice of the pie.
So less shares
are out there. You have less shares out there, so it helps prop up the earnings per share. So it's not necessarily going to help the total earnings of Apple, but when you divide it by the number of shares out there, they're shrinking the number of shares. And sometimes these buybacks are viewed as a management's view that maybe the shares are undervalued. So there's kind of this signaling effect that can happen too, where the company's like, you know what, we are so confident in our growth that we think that the shares are undervalued, so we'd like to buy those.
So let's wrap this all up. The fighting inflation is a long game for certain, and we can see around the world, Swiss National Bank and others are also starting to see this as well. It's headed generally in the right direction.
That's right, in the right direction, but at a glacial pace, it really seems like. The Eurozone, they are likely to start cutting rates already in June. We also have, say, Japan, which is on the other side, where they're likely to start hiking rates. There have been some interventions by their bank for their currency, and really, they were sort of the last man standing with negative interest rates. Now we have the Federal Reserve, where there's a fairly high bar for the Fed to start hiking rates again, but a fairly low bar are for them to start cutting. Market is beginning to price in, as you said earlier, maybe 50% probability, 70% probability sometime in September or November.